This meeting is being recorded.
All right, the December 15th, 2022 investment meeting of the NYCERS Board of Trustees with the participation of certain trustees from BERS who we'll acknowledge later will now come to order. Ms. Winnery, will you please call the roll of the NYCERS trustees?
Good morning, Chair, Mayor's Office.
Brian Berge, representing Mayor Eric Adams.
Comptroller's Office.
Allison Hirsch, representing Comptroller Brad Lander, and
John Dorsa, alternate for Comptroller Brad Lander.
Public Advocate's Office. Borough President Manhattan.
Keisha Sutton James, representing Borough President Mark Levine.
Borough President Brooklyn. Borough President Bronx. Sorry. Borough President Queens.
Alan Swisher for Queensborough President Donovan Richards.
Borough President Staten Island.
Dan Master for Staten Island Borough President Fasella.
International Brotherhood of Teamsters.
Ruben Torres and Lawrence Bosley for Teamsters Local 237 President Gregory Floyd.
International Transport Workers Union.
Dave Katzman for TWU Local 100 President Richard Davis.
And District Council 37.
Excuse me, Ray Santander for Executive Director Henry Burrito. I don't know if Robin's on the call.
I have not seen her yet. We have a quorum.
All right, thank you very much. And will the trustees and members of BERS who are on this meeting today please acknowledge themselves for the record?
Good morning, Brian. Russell Buckley here, trustee at BERS, on behalf of the Chancellor, David Banks.
And we'll note that Allison Hirsch and John Dorsa are on also as trustees of BERS.
All right, so I think we're ready to get started here in the sense that the agenda today largely concerns the operations of our dear colleagues at the Bureau of Asset Management. I think I will hand over the mic, so to speak, to Ms. Hirsch and Mr. Dorsa to conduct the meeting here in public and executive.
Thank you, Chair. Before we begin the formal agenda, I believe that there is a resolution for one of our colleagues in the Comptroller's Office who has also served as a trustee to this fund. And I believe we have a resolution that we're going to discuss prior to commencing with the formal part of the agenda. Ms. Winnery, is that correct?
That is correct. And with the will of the board, I'll read the resolution into the record. We're recognizing David Jeter for his service to the NYCERS membership and board of trustees. So with that said, whereas the New York City Employees Retirement System, the system, recognizes exemplary service performed by individuals appointed to serve on its board of trustees, and whereas David Jeter has served the city of New York in the Bureau of Asset Management of the New York City Comptroller's Office since 1981, faithfully having served 7 comptrollers in every aspect of the office, including as a trustee, and most recently serving under Comptroller Brad Lander. And whereas Mr. Jeter consistently combined professionalism, dedication, enthusiasm, knowledge, a sense of humor, and exhibited a firm commitment to faithfully fulfilling his duties in his many roles within the Bureau of Asset Management and his fiduciary responsibility during the time he served as a trustee. And whereas during official proceedings of the system, Mr. Jeter has shown leadership and professionalism and promoted positive and effective discourse during such proceedings, and always acted for the benefit of the participants and beneficiaries of the system. Now, therefore, be it resolved that the Board of Trustees of the New York City Employees Retirement System does hereby express its deep gratitude to David Jeter for his years of exemplary service to this board, the beneficiaries and participants of the system, and be it further resolved that a true copy of this resolution be presented to David Jeter along with the trustees' wishes of continued success in all of his new endeavors. And with that, I'll open the floor to anyone who would like to comment.
Yeah, It's been a pleasure to work with you, and I have admired you from the time that I've started. As I've learned more about your history, I am absolutely amazed and just awed by your sacrifice and by all the hard work and everything that you've been responsible for. And I have no idea how they want to replace you. I'm really nervous, to be quite honest. Sorry you're going, but I really appreciate having worked.
Thank you, Melanie and Leroy.
Ray Santander here. David, thank you so much. And everything that Larry said just goes double for me. Tremendous steady influence on the board and making sure the bills get paid, the contracts are all lined up the way they need to be. I agree with Larry. Don't know how we're going to get along without you, but we'll just have to find a way. So best of luck to you in all future endeavors, and thank you for your amazing dedication to the city of New York.
So David, this is Brian Berge from the mayor's office, but you may remember me from my time in the law department. And I have an anecdote that I thought you might appreciate from that time. So you recall, I'm sure, the Bank of New York Mellon foreign exchange litigation in which we had issues with a former custodian's conduct of foreign exchange transactions against our interest was the allegation. And you may recall a very long deposition that you had to sit for. Well, there was a break in that deposition at one point, and I was kind of not maintaining my distance entirely from the high-powered lawyers on the other side. And they were kind of grumbling to themselves because depositions are unpleasant for everyone. And I heard them say, this guy is the key to the entire case, sort of under their breath a little bit. And that was true. And I think what they kind of meant to say was, this guy is the key to the entire place. That was my experience of working with you on that matter. And I have utter faith in the comptroller's office to staff appropriately, but I don't know that faith can extend to replacing your time here. So with that, I wish you the best of luck in retirement, and I wish us the best of luck.
Thanks, Brian.
So unfortunately, in pensions, at one point you're an asset, and the other point you're a liability. But we have some time. We got a couple of weeks till that happens. David, it's been an absolute pleasure having worked with you for the last 20 years. Barely half the time that you've been with the comptroller's office. And just to remind some of the newer trustees, when David began in what was the Bureau of Investments before it was the Bureau of Asset Management, the assets of the collective 5 retirement systems was approximately $10.7 billion or so. And today we stand well over, depending on the day, well over 225 billion. So we've come a long way. And so has David, from his humble start in the comptroller's office as a junior accountant to assistant controller of the Bureau of Asset Management, which is no small feat and should be the envy of every public servant. And I also want to note, David is also a Sloan Award winner for public service, which is one of the highest honors that the city can bestow upon a public servant. And I think that just speaks to the exceptional qualities of David, that not just the people in the Bureau of Asset Management have recognized all these years, but that the city has as well. So I just wanted to put that on the record and memorialize it. So thank you, David.
Thank you, John.
I said most things I need to say about David the other day at our internal BAM party, and I just want to thank him again on the record for everything he's done to help with my transition over the last year. And say that, Brian, I am not confident that we can function without him. So we'll see what happens in January. And I want to remind everyone that we are having a retirement party for David next Wednesday from 4 to 6 in the controller's office. And you should all have invitations in your inbox, and you are all on the list. So we really, after 41 years, David deserves a party, even if he really doesn't want one. And I would love to see you all there to embarrass him in style. So.
Gee, thank you, Allison, for inviting the world.
Yeah.
No problem. I'll keep going. I'm going through the alumni list of the controller's office one by one.
Well, thanks everyone for this time. It's been a pleasure to serve.
No, we haven't passed the resolution yet.
Oh goodness, so good.
Maybe you want to save that. Maybe
as
we
you
want
can
to see if we
see,
can pass first.
you can see, I would like to get this painful moment of my life. Okay.
Well, David, this is Ruben. Hey, Ruben. This is Ruben. I want to extend your pain right now. And I want to say that thank you for the 40 years plus of service to the city of New York. You're part of what makes this city function. And it's something that many don't get to see or recognize. You've always been a constant, steady, calm factor in city government. Your institutional knowledge that you have is probably unmatched at this point in city service. And we really appreciate everything you've done for the city of New York and the members. And retirement is something we all strive for. And enjoy yourself. You did a tremendous job for everyone here in the city of New York. And I want to thank you on behalf of the workers and the members in New York City. So enjoy yourself. Yes, be embarrassed. You're a humble person, but you deserve it. You deserve the accolades. So be well.
So with that, Allison, would you like to make a motion?
I'd like to make a motion to pass the resolution to honor David Jenner, the one and only.
I will second that.
Piling on to second.
I'll call that a third, right? Well, this resolution will pass by consensus.
R1.
And I would respectfully request that a copy of these minutes be provided to David so that he can have this for his personal records. Thank you.
So noted.
Thank you to all of you. It's been a pleasure to serve, and it's also been a pleasure to make sure that the Bureau of Asset Management is delivering good service to you. So I think everyone will be fine in the future. So, but thank you, everyone. John.
So with that, from 41 years to 5 months, we're going to hear from the Chief Investment Officer, Steve Meyer, who's going to provide us with some comments in public session regarding the performance of the fund. So Steve, we'll turn it over to you.
Great, thanks, John. And although I've only been here 5 months, it quickly became apparent to me that David is irreplaceable. And Larry and Ray and Ruben, I share your concerns. I'm worried about him going as well. So, but we'll do our best. And we'll, like I said, he's irreplaceable, but we're going to do our best to make sure we don't miss anything. Before I get into my comments, just one quick note of housekeeping. Our typical or normal Friday thought leadership Zoom call tomorrow morning has been canceled. Unfortunately, our scheduled speaker came down ill, I believe with COVID. So I think we are done for the year, but we have a robust calendar starting the first Friday of the new year. So please bear with us. And we really appreciate the comments and the engagement we've gotten from the trustees for NYCERS on all those calls. So thank you.
I just want to say, Steve, personally, every speaker has been fantastic and seemingly, if that's possible, one better than the other. And it's just been incredibly helpful to me in terms of rounding out my knowledge of pension investments and actually knowledge that I take to other boards and funds that I serve on and allow me.
Ray, we can't hear you when you're looking.
I'm sorry.
down.
I've been able to take the knowledge and the insights gained through these these tremendous conferences elsewhere to other boards and funds in which I serve, and it's just been great. Thank you so much, and I can't wait to see who comes in next year. Thank you again, sir.
Sure, Ray. It's our pleasure, and I'm glad that you take that knowledge and pass it along. That's the only good thing about having knowledge is if you can share it and use it in your work. So that's great to hear. Well, hopefully I'm going to impart a little bit of knowledge in the next few minutes. I'm going to provide a brief update on the economy, financial and investment markets, and more importantly, your performance in the third quarter of this year. Moving to our first slide, inflation is top of mind around the world. Inflation actually hit a 40-year high in the third quarter of this year, but the fourth quarter results have been actually quite encouraging. We've seen inflation come down about 200 basis points or 2 percentage points. I'll talk a little bit more about that in a moment. Employment in the U.S. continues to be incredibly strong, placing significant wage price pressures, particularly in the service sector. That coupled with the residual supply chain bottlenecks has been pushing up input prices higher and resulting in inflation. We're also still impacted by the war in Russia, the Russian war invasion of Ukraine, and the oil and energy price shocks associated with that. Even though that's come off the boil, we're still seeing some pressures in energy. So inflation's been front of mind here and abroad. And more recently, the Fed Chair Powell actually reflected that inflation is spread broadly throughout our economy. Next slide. CPI is well up its 40-year record high. As I mentioned, it's down 200 basis points in November to just 7.1%. So certainly moving in the right direction, still several times higher than the rate that the Fed would prefer to see. Core PCE inflation on this chart is reflected in yellow. It's still sticky at elevated levels, but it is about 5%, come down a little bit in November and expected to move lower in coming months. And this graph shows in white the CPI up top, and you can see it's clearly come down and moving directionally correct. And again, core PCE should follow soon. On the next slide, as I mentioned, inflation's been a global phenomenon and a challenge. You can see in the red line on this chart, that reflects the US CPI coming again off the boil, coming down. In the UK, however, it is at its high at 11.1%, and their CPI measure. And in Europe, it's actually come down a little bit. It was a high of 10.6%. It's come down to 10%. ECB Chair Lagarde has been on the screen talking about continued rate hikes, quantitative tightening, and 50 basis point rate hike today. So there's still more challenges in Europe as well, and certainly more pain to come associated with the war in Ukraine and the price pressures that it's put on economies and energy in particular. On the next slide, University of Michigan survey results show that people are starting to expect inflation to move down as it should, given the Fed's policy stance over the next 12 months. So here it reflects a 4.9% expectation for the next 12 months, and certainly moving in the right direction. On the next slide, as I suggested earlier, U.S. employment continues to be incredibly strong. November employment was up 263,000 jobs. In the third quarter, unemployment hit a 50-year low at just 3.5%. October and November were both at 3.7%. They both surprised the market on the upside. Expectations were that it would continue to slow and perhaps pick up a pace, but employment continues to be very, very robust and strong in the economy. On the next slide, actually looks at the unemployment rate. We still have a persistent post-COVID imbalance in our labor market. We have about 4 million open positions that don't have enough candidates to fill them. And that's largely due to what's reflected in that yellow line. That is the labor force participation rate. And you can see it's still about 1 full percentage point plus below where it was pre-COVID. So a lot of people took the option of retiring early during the pandemic. On the next slide, U.S. third quarter gross domestic product growth was up 2.9%. That was revised up from 2.6%. So the economy is still doing quite well. Remember, that comes off of 2 consecutive quarters of negative GDP growth in the first quarter and the second quarter of the year. And the fourth quarter looks quite strong at around 2.5% to 3.25% growth. So again, notwithstanding the fact that we've had the Fed tightening monetary policy and financial conditions, the economy continues to do quite well. And that just indicates to me that we're probably going to be in this hiking cycle and higher for longer than the market currently expects. Global economic growth has also been sluggish overall. It's slightly over 2%. On the next slide, you can see evidence of that and an explanation. That red line that kind of hovers above all the others, that is China's gross domestic product growth, which for most of the past 10 years has hovered between 7 and 8%. Obviously, with COVID came off and they had the spike in recovery as well. But given the zero tolerance to COVID policy they've had in China, it certainly had a negative impact on growth and productivity. They're coming in now slightly about 2.5%, again, versus their typical of 5, 6, 7, 8%. And they have not recently been a growth engine for the global economy. And that the hope and expectation is for that to change in the coming months and quarters. On the next slide, housing is certainly one significant negative factor impacting U.S. growth. And you can see on the left-hand side of this chart, that red line, those are existing single-family home sales. They're down over 20% since the Fed first hiked rates in March. And that is an incredible decline in a very short period of time. And something that certainly will have an impact on the economy longer term. On the next slide, overall housing inflation is poised to move lower. You can see here the green line is actually the new lease inflation. It's expected to move lower in 2023. And that basically means as leases come up and they're renegotiated, they'll be negotiated at higher levels, but not quite as high as they had been when I signed my lease here in New York City in July, which was probably the peak. Owner's equivalent rent, also reflected in blue, is near peak and will likely come down over the course of the coming months and quarters. On the next slide, U.S. consumers have been incredibly resilient in 2022. This surplus savings, or this extra savings, if you will, that they accumulated during COVID, peaked at about $2.6 trillion and continues to support spending in our economy. However, the dry powder is being depleted, and you can see that on the lower right-hand side. That is deficit spending by many consumers in the U.S. economy, particularly in the lower half of the income spectrum. And that's also evidenced on the next slide in terms of the increase in consumer debt levels, and primarily credit card debt has been moving up pretty steadily and pretty significantly in 2022. Again, supporting growth, but again, I don't think that's a positive trend. On the next slide, the Fed's response to high inflation has been incredibly aggressive. We've had 7 rate hikes this year to date, and I don't foresee any more because there aren't any more scheduled meetings. But remember, the Fed started out in March. They went 25, 50 basis points, then 4 by 75 again, which is unprecedented. We have to go back to the 1980-81 period to see something like that. And then most recently, yesterday, they raised rates another 50 basis points. So they've gone basically from a zero lower bound to 4.25% to 4.5% official interest rates. Really incredible moves. Also worth noting is we have the Bank of England raised rates 50 basis points today, as did the ECB, both including the Fed, all 3 indicating there's more to come in that area. On the next slide, you can see evidence. I love this chart because it reminds us of history. On the far right-hand side, you can see, again, that's the rate hikes through before yesterday's 50 basis points. But it is, as I said, fast and furious, and the Fed is certainly addressing this record spike in inflation. On the next slide, just a little different look at that. It looks at the Fed tightening cycle over different regimes. And again, those, what's not reflected on the bottom, those are the number of months. So again, the Fed has been very, very, very quick making these sizable increases in rates. If you look back to 2016, 2018, the most recent hiking cycle, remember the Fed hiked 25 basis points once, and it took a year off before they hiked again. So this is really unusual and quite unprecedented. On the next slide, the significance of the bond market declines and disruptions and dislocations this year cannot be understated. It has really been an incredibly interesting time. Not a very rewarding time, but certainly an interesting time to be an investor in fixed income, both here and abroad. U.S. Treasury 10-year yields started the year at about 1.5%, 1.5%. They traded as high as 4.25% in November, and it's come off the boil, coming down to 3.5% right now. And we'll see where it goes as the Fed continues on its path of hiking rates. We also have what's referred to as a yield curve inversion, which is somewhat rare. Typically, when you invest further in maturity or further out the yield curve in time, you pick up a premium associated with the uncertainty and the less liquidity out further. Right now, we've got an inverted yield curve measured by the 2-year U.S. Treasuries relative to 10-year U.S. Treasury yields of about 76 basis points. It hit 80 basis points last week. The previous record high was 2.5 percentage points, or 250 basis points, experienced in 1981. On the next slide, another look at the U.S. yield curves. And you can see that the Treasury yield curve has shifted higher significantly this year on the left-hand side. The most recent look at the curve as of the end of November shows a spike on the far left-hand side, again, evidencing short-term rates, evidencing the fact that the Fed continues to raise rates and they will continue to do so into 2023. The inversion on the right-hand side, again, 76 basis points, is unusual. It's an unusual occurrence when you see short yields exceeding high yield, longer-term yields. It also indicates that the market believes there will be a recession occurring in the coming quarters that will cause the Fed to reduce short-term rates and reestablish that normal relationship of longer rates, longer maturities having higher rates. On the next slide, on the top red, which I think is the most interesting aspect of this slide, you can see that high yield spreads have been fairly volatile this year. They started out around 300 basis points above comparable maturity U.S. Treasuries. They went as high as over 620 basis points. Right now, they're about 435, 440 basis points over. More interesting, certainly, than 300 basis points plus, but not necessarily compelling, particularly if you think that the Fed rate hikes will land us in a recession at some point in the coming months and quarters. On the next slide, U.S. dollar strength has been a consistent and persistent theme throughout most of this year. It's been very challenging for U.S.-based companies with sales and revenues earned from abroad. As they repatriate those, it has a negative impact on earnings and sales as they adjust down because of the strength of the U.S. dollar. I think it's been probably even more challenging for many of our non-U.S. trading partners. And a lot of commodities, in particular oil, is priced in dollars, which makes the energy spike much more painful for those abroad, say in the UK, in Europe in particular. However, on a more positive note, the bottom right-hand headline shows that the dollar is sad. It's come off the boil, and you can see that on the next page as well. The next slide on the far right-hand side indicates, you can see that it's been a very strong experience for the US dollar this year relative to this 20-year chart. But you can see in all other areas relative to the euro, the pound sterling, and the Japanese yen that's come off the highs. On the next slide, I asked you the upper left-hand slide quote, I think is the most interesting from the New York Times. And I'll actually read it. It says that this has been the most devastating time for bonds since at least 1926 and maybe in centuries. But the good news is much of the damage is already behind us. We've seen a lot of volatility associated with what's going on in the fixed income market spill over into the equity market, particularly having a negative impact on growth stocks and assets. On the next slide, is again, as a former bond portfolio manager, this is incredibly interesting to me, really unprecedented when you see the magnitude of the increase in spreads or increase in yields rather across the world's sovereign 10-year treasury issues. You look at to the far right, you can see as of the time of this print a couple of days ago, the US 10 years have moved up 219 basis points. And that's fairly consistent throughout all these markets and economies. Two notable exceptions. On the lower right-hand side, you can see that Japan, their yields, their 10-year yields have only come up 18 basis points, and they are artificially being held down by yield curve control or qualitative easing, if you will, in the Japanese market. There are days in the Japanese JGB market where there is absolutely no trading because of that artificial construct and holding down yields below where they would be. And the only sovereign 10-year treasury worth note that's had a decline in yields this year is on the very, very bottom on the far right-hand side, China, because their economy slowed and inflation hasn't been as big a problem there because of the sluggishness. They've been easing rates as opposed to hiking with the rest of the world. On the next slide, a quick look on the left-hand side, that's the volatility index or the VIX. Typically over 30 years, it's averaged 19. It's 22 today. It was as high as 30 the last time we spoke, and it's come down quite a bit. I'd say more interesting is on the right-hand side, the MOVE index, which looks at the volatility of US Treasuries, still elevated and still very high pretty consistently throughout the year. On the next slide, in terms of market returns, on the left-hand side, you can see a 10-year chart of the Russell 3000, still down 18% year to date. In blue, the developed international market down about 23%, reflected in gray, and the emerging market stocks down about 30% in red. It's been a challenging year for equity investors. Perhaps even more challenging given expectations for fixed income. On the right-hand side, you can see the Bloomberg US aggregate index. It is down substantially, about 16% year to date. And on the next slide, not to make things worse, but if you look at a typical 60-40 portfolio, it's been down 60% year to date. So a very challenging time for all manner of investor. And lastly, on the next slide, just a couple quick notes, recent headlines. You have no exposure to crypto in your portfolios. We're not crypto investors. So for the record, I want to make that clear. However, there have been some disruptions in the market in the crypto space in particular with some notable bankruptcies and infecting risk assets generally. You can see the upper left-hand side, it talks about FTX's collapse and ultimately bankruptcy. We've had also volatility in the geopolitical front in the UK. They had 3 prime ministers within 3 months, although things seem to have stabilized somewhat. On the upper right-hand side, you can see that Credit Suisse has had some problems in its business lines and has been in the press and concerns about its creditworthiness, although I think they're overblown. In the middle on the right-hand side, we continue to have a war in Europe with Russia's invasion of Ukraine, which is putting a damper on many aspects of global growth. And not least, on the lower right-hand side, the Chinese unrest associated with lockdowns and their COVID protocols. They seem to be moving away from those, but again, these are just risk factors to think about and look at as we think about our investments. A couple last notes on the next slide. This has absolutely no predictive value. I want to be very clear on that. This is a volatility index of the VIX. What they did for this chart is they overlaid the 2006 to 2009 period with what we're seeing today. And it's kind of eerie that it follows a very similar pattern throughout the declines that we've seen in 2022. Perhaps more interesting or more disconcerting is the next slide, which actually looks at the S&P 500. It's following a similar path to what it did back when Lehman defaulted. And you can see that if it were to follow through, we would see another down leg in equity prices. And this typically what you go through the process of seeing a rate shock when rates are raised this quickly, this significantly, followed by what we'll probably see in the first and second quarters of 2023, an earnings shock or decline in earnings. And the real risk is that this spills over into a liquidity shock in the marketplace, which we don't really see evidence of that's meaningful right now. And on that happy note, let's take a look at your third quarter investment performance. On slide 32, thanks, Kate. You can see in the middle there, it's been obviously a tough quarter for the financial markets, although we did claw back some of the earlier losses. It's been an even tougher year in 2022. You can see evidenced by the significant red and the significant numbers that are reflected there, really pulling down the returns for the last 5 years in some sectors. And this is across public markets. The next slide takes a look at your public market returns by strategy. And here you can look on the upper portion, the first three are equity. So for the quarter, for the 3-month period ending September 30th, equities were down 4.6%, world ex-US down 8.9%, and emerging market equities down 11%. And again, that follows a pattern. Although we had some rebounds, still for the year, we're off pretty significantly. Similarly, we're off significantly in fixed income as well in the marketplace. And again, NYCERS investment performance in the public sector is certainly in line with what the broad market has experienced in 2022. On the next slide, perhaps a much more positive slide, is a look at our private manager returns by strategy. You can see in the 1-year space, you've had nice moves up in private equity at over 9%, core real estate up 30%, non-core opportunistic real estate up 23%, infrastructure up 14%, and opportunistic fixed income up 1.2%. These numbers are through June 30th, with the exception of opportunistic fixed income, which takes through to September 30. So a much more positive and a very different story in the private sector space. And there's been some legitimate questions raised about the robustness of the marks, but we continue to have a high degree of confidence in the part of our general partners to continue to appropriately mark their assets in line with what's realistic. On the lower portion of the slide, you can look at your NYCERS total plan returns relative to your policy returns. So although you had for the last quarter a negative 4.3% return, you've outperformed your policy returns by about 120 basis points. I think it's more like 119 basis points. So on a relative basis, still faring okay. On the next slide, a little detail of that outperformance relative to, again, policy. Although you're down, your portfolio is down, you're still outperforming on the far right-hand side, due mostly to investment manager selection by 150 basis points. And with a slight offset for under and over allocations in certain sectors and the allocation effect, the excess return is again 120 basis points or 1.2 percentage points. On the next slide, we take a look at the public market excess returns for the third quarter, right in the middle there. And you can see that your returns have been mixed relative to benchmark. We're 10 basis points behind the Russell 3000 in your portfolio, but we've outperformed in the world ex-US 29 basis points, emerging market equities by 58 basis points, structured index for really fixed income up 26 basis points. Linkers or tips have been below by just 4, high yield outperforming by 20. Convertible bonds, a very interesting story. We've underperformed because your investment managers or active managers, they tend to be more defensive. So in a risk-off environment, which dominated in the last 12 months, you can see that right next to it, they've outperformed by over 7 percentage points. But the third quarter was more of a risk-on as the markets recovered somewhat. And that's the reason why you've had a little bit of a lag or underperformance relative to the industry benchmarks. Again, because your investors have been, your investment managers have been more defensive. On the next slide, We look at NYCERS private market excess returns. It's a very different story. Here we've got private equity outperforming 1 year, again through June 30th, by 2,470 basis points. Obviously very, very significant. And in all areas, outperformance with the exception of the non-core real estate and opportunistic, down by about 573 basis points. And that's more related to the fact that we put a lot of money to work in non-core over the last several years. And primarily from 2018 to 2022, you've had mostly capital calls and very few distributions, which is evidence of the decline relative to benchmark. So again, that we just ask for you to be patient with that, and we believe that will come roaring back in the coming years. On the next slide, I'll look at your rebalancing activities for the third quarter. You can see on the upper left-hand side, we actually sold large and mid-cap and small-cap equities to basically reallocate the non-US large and mid-cap that have performed strongly. More recently, non-US developed market equity is done quite well. And the rest of it is really just to raise cash. You can see we sold a number of fixed income products to raise money for the cash desk, really to meet capital calls and to meet distribution requirements to pay your beneficiaries. And on the last slide of this section, just a look at your over and underweights, and they're certainly all well within the ranges that we have through your asset allocation and your investment policy statement. And with that, I'll open up to questions if there are any. If none, John, I'll turn it back to you. Oh, sorry, Larry, did you have a question?
Yeah, I did. I'm sorry. On convertibles, when you were saying that they were being more conservative, if we can turn those into bonds or turn the bonds into stocks, could you explain a little bit about how they weren't able to convert, or what you were talking about? How did that end up having them underwater?
Yeah, so the convertible bonds are highly correlated to equities. And when the equities are off, convertible bonds tend to trade off significantly as well. So it's a good point. As equity prices have moved down, it doesn't really make sense to convert, because typically you want to convert at higher levels.
Mm-hmm.
In terms of conservatism, Larry, our external active managers typically won't put positions on that are more than, say, 5% allocations to healthcare or tech, which tend to dominate. They tend to be more conservative and look for broader distribution and broader exposure across. And that's another reason why we've seen their defensiveness not be very positive for the last quarter. Again, if you look at 1 year, the outperformance relative to the benchmark is over 700 basis points or 7 percentage points.
Gotcha.
And that's also, the market tends to be highly impacted as well by Tesla, which is a big tech stock. And that stock this year is down 60%.
Yeah, gotcha. Thank you.
Sure, Larry, anytime.
Steve,
Sure, right.
A question. Based on the guest speakers that we had, and they were talking about the gentleman from BlackRock, that once in a generation opportunity to get into higher fixed income, which I believe meant private debt. Is that something that that BAM is exploring?
Absolutely. That was John Zito from Apollo, and that was a wonderful presentation. We actually have a dedicated resource now. We've asked Tina Sue to actually spend all of her time on private credit, and she's doing a great job there. So we continue to look for opportunities. We continue to engage with managers, and I actually believe that there is a significant migration from, Ray, as we've heard on a couple of speakers, from the public markets more to the private markets that we can certainly benefit from. So that's part of our OFI offering, or opportunistic fixed income. But Tina's focus going forward will be primarily on private credit and private debt opportunities.
Would it be possible at some point to follow up with her on any questions that I have? Absolutely. She's encyclopedic in terms of her knowledge of that sector. So absolutely, Ray. It's Great. Thank you very much, Steve.
Sure.
If I could ask a follow-up question on what Ray said real quick, Steve.
Sure.
Just kind of on the fixed income in general. How do we expect all this information around rising rates and then eventually lower rates in the long term, this expected opportunity in fixed income, possibly private credit as well, to inform like asset allocation conversations in the new year, if at all?
Yeah, that's a great question. So we've gone through a 30+ year secular decline in interest rates. And we really saw the bottom of it with 10-year yields below 1%. So we're certainly off the zero bound in terms of official interest rates. I think that as going forward, we have a couple of forces in the marketplace that are battling each other. The demographics are a lot of people are retiring, which tends to long-term be disinflationary. But we've also got things like climate change and dealing with climate change that tends to be more inflationary. We've seen a move towards deglobalization or onshoring or nearshoring, which probably moving from very low-cost centers to other areas will probably be somewhat inflationary. So as we've gotten off that zero bound and there's now some yield to be had in fixed income, I think it will do a better job providing that ballast, that offset for equity price volatility going forward. I still believe fixed income has a place in all portfolios as a core holding. And then around that, where do you pick your opportunities? And I do think to raise question and a couple comments that were made on our thought leadership calls, that there is a lot of opportunity in private credit, secured and unsecured, and opportunities to be a little more aggressive and also defensive there, depending upon where we see the market going. So I do think there'll be continued opportunities in fixed income going forward. They may not look like they did in the past, again, with that migration to that move from private or public assets to more private securities or private partnerships. But as I said, I still think they have a place in your portfolio as a core holding.
I appreciate that. It's interesting. So basically potentially more of an allocation towards a private credit OFI, maybe keeping fixed income allocations around the same.
I think that's right. Yeah. Okay, perhaps moving a little lower in public and putting a little bit more to work in private. We have the basket clause that we need to work around in terms of that really drives our ability to invest in what I guess historically has been thought of illiquid securities. Private credit is illiquid or less liquid, certainly in the public securities, which are much more liquid.
Dare I ask for an update on basket clause legislation?
I don't have one. If there was one, I would suggest perhaps
There
Allison.
is one. I mean, there's one somewhat that I can jump in. So the legislation was actually delivered to the governor's desk on a Monday afternoon. So we are in the 10-day window that she has to either sign or veto it. And we will know. So we'll know by the end of next week for Christmas. We are, doing everything we can to reach out to the governor's team to urge them to sign it. I know Brad reached out again this morning. If anyone from the unions or the city wants to reach out and urge them to do the same, we would happily have that support. I know some other folks are, so we'll know in the next week.
Thank you, Allison.
Any other questions?
Yeah, no question. I just have a comment, Steve. I'm glad that you're looking at the opportunistic credit. Every conference I've been going to lately, that is the hot topic, and I've been approached quite often by those managers. As a matter of fact, Stepstone is offering a 12% guarantee, which I'm not quite sure I understand how they do that, but so there's a lot of discussion about that, and it's hot right now. So I'm glad you guys are looking into it.
Yeah. I think it's appropriately getting a lot of attention now because I do think it's a good place to invest. And really, I think a lot of your returns are going to be driven by your investment manager selection. I was reading something on Bloomberg yesterday. It said that the top 10 managers of private credit equate more than 50% of the overall market. So It's a little bit concentrated. Perhaps over time, we'll be able to look for other opportunities, but we actually tend to invest with the cream of the crops and the very top investment managers in that space.
So, Steve, if you have no further comments, I believe that there's a risk portion that Ed Berman is going to walk us through.
Yep.
So we'd like to invite Ed to
Yep.
Thank you, John. I'm here. And hello to everyone. Can we have the risk deck on screen, please? Thank you. So for this quarter, we'll follow generally the same structure of the risk presentation last time. There will be 3 parts. Page 1 will give you a top-level overview of the portfolio risks and the relation between the portfolio and the benchmark. Page 2 will provide a more granular breakdown of risks to give you a sense of risk concentration at the individual asset class level and the connection to the performance. And finally, on page 3, we'll focus on the forward-looking projections. And that's where we'll show you some new analysis we developed at BAM as we expand our risk framework. So let's start with the top-level view. So the total risk for your portfolio at the end of the quarter stood at 12.8%, an increase of about 0.4% for the quarter. You will see this number at the lower right corner of the table. It's highlighted in bold font. And just to remind you, this number represents the expected return of the portfolio over the next 12 months, meaning that we project the gains or losses for your portfolio to be within 12.8%. And that also means that it's about a 15% probability that gains will be larger than 12.8, and also a 15% probability that the losses may exceed minus 12.8%. But what does this number mean? What is the kind of intuition behind this number? Broadly speaking, the level of risk is determined by 2 main considerations: by markets and by the portfolio construction process. So to understand these numbers, we'll follow generally the same framework we introduced at our last meeting. Let's start with the portfolio construction. The main decision when building a portfolio is to establish the allocation to equities, or the so-called stock bond split. Historically, equities delivered the best returns, but also the highest level of risks or losses. We capture the first step of this process by the market portfolio in the table on the screen. You see it in column 1. It's a simple 65-35 blend of the MSCI all countries and Barclays US aggregate, the broad measures of equities and fixed income. The next step of the investment process is to determine the asset allocation within each category, where you establish the ranges for US equities, emerging markets, core fixed income, and other asset classes. These decisions are captured in the strategic benchmark, where the market portfolio is split into 12 components. You can see them at the bottom of the page. The exposures for the policy benchmark are captured in column 2 in the middle of the table. And finally, the last step of the process is the manager selection and the technical rebalancing cash needs and cash flows. So this step, the actual portfolio, is captured in column 3 of the table. So by following this framework, we can better understand the numbers and identify the drivers of the risk and changes of risk. Let's start with column 1, the market portfolio. That is a 65-35 blend of equities and bonds. There are 3 main dimensions of risk that we take in this portfolio: equity, interest rate, and credit. These risk dimensions are reflected at the top of the table on the portfolio construction. Equity exposure is captured by equity allocation, which is obviously 65% by construction. The next dimension of risk is interest rate, or time value of money. The best way to measure exposure to interest rates is through duration of the portfolio. You can see that the duration is 2.2 years. But what does this number mean? Again, I think of it as a helpful scaling factor, just a multiplier. And the duration of 2.2 years simply means that a 1% decline in interest rates translates into a 2.2% gain for the portfolio. You can notice that this number declines slightly for this quarter, and it's just simply a result of an increase in the market interest rates. The last dimension of risk is credit spread, which is a measure of default risk. Only bonds issued by the private borrowers have exposure to credit risk. For this reason, only about a third of the Barclay US Ag brings the default risk of credit exposure. For this reason, you see that the number is lower, 1.3. And again, we use the duration measure to capture the exposure to credit spreads. And the 1.3 simply means that a 1% decline in credit spreads translates into 1.3% gain for the portfolio. So how does this portfolio construction translate into risk measures? You can see it at the bottom of the table under portfolio risks. There are two measures of risk that we capture here. First of all, total risk, which stands at 12.5% at the end of Q3. Again, to remind you, it's just a measure of expected performance, meaning that our center expectation for the market portfolio, for the performance of the market portfolio, is 12.5% over the next 12 months. You can see that this risk, the total risk level for the market portfolio, increased by about 0.5%. And that's entirely driven by the markets. Just as Steve highlighted his presentation on the market exposures, these are truly historical times. At the end of September, the VIX index, a measure of equity volatility, closed at over 30 versus its peak COVID average of 18. Since then, equity volatility came down slightly. It stands at 22. VIX stands at 22. The action was even more extreme in the fixed income markets. In the end of September, the MOVE index closed at about 160, which is close to its highest historical level outside of the global financial crisis. And that's compared to the pre-COVID average of around 60. So it's not surprising that the total risk level ticked up for the market portfolio. The other risk measure we show you is more to capture a shorter term metric. That's the beta to the S&P 500. It's a measure of how the portfolio will perform when the overall stock market moves up or down. So the beta of the market portfolio shown on the bottom right corner of the table, bottom left corner of the table, stands at 0.61, almost unchanged from the previous quarter. That number means for 1% increase in the S&P, your portfolio will gain 61 basis points. It's interesting to know that the beta is actually smaller than the equity allocation of 65%. The reason for this is the allocation to fixed income and international equities and the results of the portfolio diversification. So it's completely within our expectation and it's a positive result. Let's move on to the policy benchmark, which is captured in column 2. You'll notice that the policy benchmark is broadly comparable to the market portfolio. The equity allocation is slightly lower at 63.5%, again, by construction. The spread and credit duration, the interest rate and spread duration ran slightly at a low level, and it's because of allocation to high yield, which tend to be a shorter maturity, and allocation to TIPS, which comes with no credit risk exposure. So you can see that this portfolio having similar characteristics end up in a slightly lower risk level. You can see at the bottom of the page, the total risk is 11.9% versus 12.5% for the market portfolio. So it's broadly, it's a positive result, meaning that we're taking comparable level of equity exposure, ended up with a lower risk level. So that's exactly the point of asset allocation, where we try to capture high returns by not increasing the risk level. And again, the last measure of risk, the beta, 0.59, again, comparable to the market portfolio, slightly lower, consistent with the total risk levels. So no big surprises here. So let's move towards your portfolio, which is captured in column 3. You can see that the portfolio is closely aligned with its benchmark, but let's go over the small differences. Equity allocation is exactly the same as the benchmark. You will notice that the small duration overweight versus the strategic, And this is due to the allocation of the ETI program, which brings longer dated mortgages into the portfolio. There are small differences, not material, for the credit spread. Again, this is mostly because of the tilts taken by the managers. So how does it translate into the risk levels? You can see them at the bottom of the page on the right-hand side. You can see that risk measures are broadly in line with the benchmark, but there are some notable differences. First of all, the total risk level runs about 0.9% higher than the benchmark. And this the difference is broadly similar to the previous quarter. The increase in risk is driven primarily by the allocation to private markets, mostly the private equity allocation. So it's not surprising that the beta for the portfolio is also slightly higher than its benchmark. And here we introduce a third risk measure, which I will argue probably the most important here, which is the active risk. Similar to the total risk measure, active risk is a forward-looking assessment of the expected excess returns over the benchmark. So active risk of 2.4% means that we expect the excess return of the portfolio over the next 12 months to be within a 2.4% range, with again, the usual disclaimer, a 15% higher and a 50% lower. The probability to exceed it is 15%, a probability to deliver worse returns is about 15%. And not surprising, as I mentioned before, the majority of this active risk is driven by the allocation to private equity. So out of the total 2.4% of active risk, about 1.5 comes from the US buyout strategies. We'll see more details on the next page. And finally, I want to draw, not yet, sorry, Kate, can go back. Just one last point, the charts on the right. That's where we captured the evolution of risk over the past 12 months. That's helpful to understand the trends in the evolution of the portfolio. And you can see that the time series that the relationship I mentioned earlier broadly held the same over the past 12 months. You notice that the portfolio is running at slightly higher risk level than the benchmarks, but the relationship, and that's what's important, between the benchmark and the portfolio held fairly constant over the time. And as the markets move in and out, as the volatility in the markets picks up, you'll notice that the risks trended higher from about December of last year. Again, you'll notice it's broadly comparable to the markets. And the last point on this page, active risk, again, no big surprises, stays fairly constant, but it ticks higher as the market volatility picks up. Just pause here for any questions. If not, we'll move to page 2. We'll dive deeper into the portfolio. Can we have the next page, please? Okay, so here we'll go over the details of portfolio allocation, the risk level for individual asset classes, and the performance. First of all, let's focus on column 1, where we show the asset class allocation and the tilts against the strategic benchmark. We show the allocations here without parking place adjustments. So it's the actual allocations shown against the strategic benchmark. You can see that the public allocations for all nodes are reasonably close to the benchmark, but there are some notable differences in the private markets. Hopefully not a big surprise here. The private equity allocation exhibits an overweight of about 2.8%. The infrastructure and private real estate allocation slightly below target. Again, hope no big surprises here. I'd like to spend more time on these contributions that you see in column 2. And actually the same information is captured in the chart at the bottom of the page, which may be a little bit easier to follow, where these contributions are marked in orange color and the allocations are in blue. So you'll notice that equities make a disproportionately high contribution to the total risk level, as expected. The allocation that punches above its weight are the US equity and private equity, which is also primarily domestic. You will notice that fixed income provides a useful balance for the portfolio to compensate for the higher risk level of equities. Core fixed income at tips have a negligible contribution to risk despite having a significant market value exposure. This type of risk distribution is typical of a multi-asset portfolio as in line with expectations and the investment process. I also want to draw your attention to the column 3, which is the active risk at the asset class level. Here we assess the active risk for each asset class against its own benchmark. Several observations stand out. First of all, active risk for public markets is well contained. It's about 1% of equity and very small for fixed income, just 40 basis points. There are slightly higher levels of active risk for the developed ex-US in equities, which is consistent with allocation to active managers, and some of our managers taking active risk of up to 17%. I was told I'm not allowed to mention names of managers in the public session, so we'll just leave it at that. Active risk for US public equities runs at much lower level, and that's because we use primarily passive managers in this allocation. There's no material change for this quarter for active risk for public managers. If anything, these decline slightly, but it's not a material change. For fixed income, again, no changes. Finally, we see large level of active risk under alternatives, which is not surprising given the idiosyncratic nature of this asset class. And it's also kind of meshes with our intuitive understanding because we see that alternatives behave quite differently from the public markets. Specifically, for private equity, which is benchmarked against the Russell 3000, active risk stands at 18%, which is an increase from 15% the previous quarter. And just to mention, most of active risk for private equity comes from the allocation to US buyout strategies, both large and small. Finally, for the entire system at the portfolio level, the active risk stands at 2.4%. You can see it at the top of the page. And again, that's driven almost entirely by private allocations, with buyout managers contributing 3/4 of that. So as I mentioned before, we measure risk in terms of performance. So how does our risk projection connect to the actual realized performance? You can see the numbers in column 4, where we show the trailing 12 months returns for each asset class. The first observation in this column is that each public note is colored red. This reflects the historically difficult markets that we've been experiencing. Both equity and fixed income markets sold off, which delivered the worst performance for the classic 60/40 portfolio, going back to almost 100 years. And the losses for some asset classes exceeded our risk forecast, especially where we rely on active managers. I'd like to point out developed ex-US, where the losses of -31% for trailing 12 months significantly exceed our risk forecast of 20%. The same relation holds true for the excess returns of -6% against our active risk forecast 2.8. The returns for mostly passive US equity strategies are comparable to these forecasts. The fixed income markets went through a highly unusual period as the rates increased at a historically unusual pace. The first half of this year delivered the worst treasuries market since the 18th century, and we clearly see it's in the negative returns on the public side. The absolute returns exceeded these forecasts by a wide margin, but what's more important, the excess returns were well within the expectations. One positive exception here are convertibles, and I believe Steve just covered the reasons for this stellar performance. The alternatives, on the other hand, delivered performance that provided helpful diversify to the public markets. Private equity, private credit, and infrastructure returns were broadly in line with these forecasts. And the real standout here is private real estate, where the performance exceeded our risk forecast almost by a factor of 2. So let's just hope this performance will continue going forward. If there are any questions, I'll pause here for a second before we move towards the forward-looking projections. Can we have page 3, please? Thank you. So you may notice that this page looks a little different from the previous quarter, and we'll take this as an opportunity to present some new risk analysis we developed at BAM. So we obviously do not know what the future will bring, and we cannot forecast the markets for the future. Instead, we're focusing on the major macroeconomical factors that may impact the performance of your portfolio. And we're trying to identify which factors we need to watch out in the future. Fundamentally, there are three groups of macro factors that impact the economy, the markets, and by extension, your portfolio. You see it in the table on the left-hand side, which is equities, rates, and commodities. So equities obviously trade in almost every country of the world, but the three most important centers are the United States, the European Union, and China, or broadly speaking, the emerging markets. Together, these three centers capture close to 2/3 of the global market equity capitalization, with the United States being close to 40%. These three markets identified by the first three lines of the table with their respective indices, the S&P 500, the Euro Stock, and the MSCI EM. The second bucket is reserved for rates, which is the cost of capital. We'll highlight three interest rates that are most important for the portfolio on lines 4 to 6. The 2-year Treasury note is the best proxy for the Federal Reserve policy rate, since it captures both the rate hikes and also the market expectations for the future policy. The 10-year Treasury note is representative of the broad economy as it is used as a benchmark for mortgages and for the investment grade debt. And finally, the euro-dollar exchange rate stands as a proxy for the strength of the dollar, which has a special role in the international market and serves as a global reserve currency. And finally, the third bucket, commodities, captures the dimensions of the real economy, which produces goods and services. Copper, in line 7, stands for the strength of the global manufacturing, since copper price correlates highly with the industrial output. Oil, on line 8, stands for demand of energy, which is a critical component for any economical activity. And finally, inflation, in line 9, is the factor that dominated our lives for the past year and doesn't need any introduction. The next step in our analysis is to identify how much the prices of these factors may change in the future. There's obviously no reliable way to forecast these levels, but we can use our risk models to estimate the market implied move. In this case, we ask a question: what will be the worst monthly market move to happen over the next year? You can see the results of this calculation in the next column of the table on the market move. These monthly market moves are estimated to have an 8% probability of occurring, which corresponds to roughly once a year. Again, I just want to repeat one more time, these are not forecasts. This is just an estimate. All it does, it represents, it captures the current market environment, and all these moves have the same likelihood over the next 12 months. I want to pause here for a moment to appreciate the magnitude of these market moves. These are truly big numbers across all three buckets. Notice that we're not forecasting the direction of the move. It can come either up or down. For example, our model sees a material likelihood that the equity market may experience up to 30% melt up or melt down over the next year. Also notice that among these three indices, the EM move has the lowest volatility and therefore the lowest risk. Somewhat unusual, the risk for the European markets exceeded those of the US, which reflects the difficult macroeconomic environment for the European economies. The numbers in the rates bucket are also unusually large. A monthly move of 160 basis points for the 2-year Treasury note would be unthinkable just a couple of years ago. Similarly, a 10% move in the dollar-euro exchange rate is shockingly big in the context of the past 20 years. It tells you everything you need to know about how unique the current environment is. And finally, the commodities bucket. A 57% move for oil means that oil price can move from the current level of $77 within the range of 34 to 120. This is huge, but intuitively it feels consistent with the markets over the past couple of years. Similarly, the monthly change of inflation of almost 3% indicates how uncertain the current environment is. So what does it mean for your portfolio? The results are captured in the next two columns, both the portfolio and the strategic benchmark. We split these results into two categories. Risk on, color-coded green, represent the rally in the market, and risk off, colored red, represents the sell-off. Excuse me. So altogether, we show 18 possible outcomes for your portfolio and 18 outcomes for the benchmark. I'm not going to read the numbers, instead focusing on the main takeaways with the goal of identifying the factors with an outside impact on your portfolio. Let's start with equities, lines 1 through 3 in the table. I'll be focusing on the risk on column, but the conclusions will be the same for the risk off. You can see that among the three markets, the US equities have by far the largest impact on the portfolio. I find these to be a positive results. Whereas the global economy is facing multiple headwinds and likely heading towards a recession, the United States stands as a strong economy with a better potential to deliver stronger performance. China and Europe face their own set of challenges, different in each case, but on a relative cases, your portfolio is somewhat insulated from the spillover effects from these markets. Next, let us look at the rates bucket. I find these results actually most interesting. The portfolio is actually not that sensitive to the Fed fund policy. For a 160 basis point decline in the 2-year rate, our model projects about a 0.7% increase in the portfolio present value. The move is slightly larger for the 10-year note, which is still not high. It's just 1.6%. But look at the move for the dollar exchange rate. Clearly, the dollar has an outside importance for the portfolio. A decline in the dollar by 10% will increase the value of the portfolio by about 6%. And finally, the commodities bucket. In this case, the price of copper has a very strong impact on your portfolio. Just to remind, we use copper here as a proxy for the overall economic activity, since the demand for copper is highly correlated with the GDP growth. The impact of copper is quite material, even larger than the dollar. A rally in the copper prices of 35% will be hugely positive as the portfolio gains 7.1% under this scenario. Oil prices have a similar large impact on the portfolio, but copper clearly a dominant contributor. Related to that is the impact of inflation. It's probably not surprising that inflation is one of the most important factors to drive the performance of your portfolio. Maybe slightly counterintuitive, but the portfolio returns are positive in an environment of rising inflation. The same trend applies to all commodities, so the portfolio benefits from the rising commodities prices. You can see that the portfolio gains almost twice the increase on the inflation rate. So let me just summarize these forward-looking projections. I would say there are three main takeaways. First of all, just to go over the main factors that impact the performance of your portfolio. One, the domestic equities. The portfolio has a lower sensitivity to the European and Chinese stock markets. Two, the strength of the dollar exchange rate. Weakening of the dollar will have a beneficial impact on the performance. Three, inflation. The rise in nominal inflation will lead to a positive portfolio return. I find this framing useful to understand the main risk and exposure in a portfolio and to connect the expected performance with the headline news that we read every day. The second main takeaway is that there's little diversification in the portfolio across the asset classes. You can see it in the chart at the bottom of the page, where we show the performance of individual asset classes for the highlighted scenarios. Almost every asset class performs in the same direction. The largest risk concentration in the portfolio comes from the US public and private equity allocations. And interestingly, the core fixed income doesn't have any material impact on performance under either of these three stress tests. And the third takeaway from the stress test is that the portfolio underperforms the benchmark under every single stress test. This is true for the risk on scenarios where the outperformance is desirable, but unfortunately, it is also true for the risk off, where the portfolio performs the same or worse than the benchmark. This conclusion gets consistent with what we saw in the first 2 pages. So I'll stop here and open to any questions.
All right, I don't believe we see any questions. So hearing none from trustees, Ed, does that conclude your presentation or?
No, that's all I have. Thank you.
Okay. And again, Ed and Steve and the rest of the team are always available to trustees if there are questions that pop up that are not addressed in the slides or that come up during any of the presentations today. They're available both online, offline, and can be called back into the executive session if there's some question that you have regarding any of the stuff that we've heard today. So with that, Brian, I'm going to make a motion to exit public session and enter the executive session of NYCERS, and also note the. Yeah. Did you second that? You said, Brian?
I did. So all in favor of that motion, please say aye.
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 All opposed, nay. Any abstentions? All right, I believe that concludes public session. We'll be moving into executive session.
So I'll ask that the recording cease.
Okay,
Thank you, Kim.
you're welcome.
This meeting is being recorded.
So there was a motion to exit executive session and to public session. I believe we're still waiting for a second on that motion.
Second.
Great, thank you, Larry. So we'll turn it over to Ms. Winery to read out the roll and then back to the chair.
The board approved the annual plans for public equity and public fixed income and a private equity investment. Details will be released at a later date.
All right, thank you very much, Ms. Winery. I believe that concludes the
motion.
Oh.
Motion to adjourn.
Mid-sentence, John. Who's going to second that motion? That rude motion.
Come on, I'm not allowed to second it, guys. Somebody, anybody.
All right, I need the extra credit, so I will second the motion. Resend.
All right, all right. All in favor of that motion, please say aye.
Aye.
All opposed, nay. Abstentions, we are adjourned, and happy holidays, everyone.
Happy holidays, everybody.
Thanks, everyone.
Happy holidays.
And to you all.
Happy holidays, everyone.
Ciao. Ci vediamo.